The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Minimum versus maximum, or maybe nothing at all. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. Talk about an unbelievable hour and a half in the market.
I stepped out of the office for an hour. When I came back, apparently we're in a whole new tariff regime.
Literally an entirely different scenario. Let's just check it out here. The S&P is now up 7%. At one point, we hadn't seen this kind of move for the S&P since 2020, of such a large move higher. You look at the VIX here, kind of crashing down here at 36. The NASDAQ 100 at one point, the biggest move higher since 2008. I can go on for hours with these superlatives, Romaine. And the 2-year 20 basis point move to the upside. Again, we haven't seen this in decades, Romaine. Short covering or what have you, some serious moves in the market.
And in fact, the extreme volatility you're seeing today is actually going to now earn this rally, something that we haven't been able to call it up until this point. Unprecedented. Monday saw the biggest intraday point swing in history for the S&P 500 and second biggest percentage point swing since the GFC. Today, Wednesday, April 9th, is surpassing those metrics and more. The NASDAQ having its best day since 08, the Philly Chip Index up the most since 2001, and a basket of airline stocks rallying the most in history. As for the S&P 500, at one point in the day, all but two of the stocks in that benchmark were in the green. In fact, you have to go all the way back to December 26, 2018 to see that type of breadth. That was the day that all but one S&P stock rose. And funny enough, that 2018 rally was also during the Trump presidency, where his comments on policy leading up to that had contributed to a 19% S&P 500 drawdown before he finally jawboned a massive rebound. This time in 2025 is deja vu all over again. A 19% drawdown, also spurred by White House policy, and a massive rally today, spurred by a shift in White House policy. The good news is that 2018 rebound did stick. The S&P went on to rally an additional 8% over 4 months, and about 35% through 2019 before the pandemic, of course, brought things to a halt at the beginning of 2020. But one big asterisk remains, and that is, well, the tariffs are still there, the minimum floor at least, and the threat of maximum tariffs, that lingers over the negotiating table.
Every country in the world who wants to come and negotiate, we are willing to hear you. We're going to go down to a 10% baseline tariff for them. And China will be raised to 125 due to their insistence on escalation.
Scott Bessent, the Treasury Secretary there. Alex, he didn't seem very excited, but that chart behind you shows the market certainly is.
Ooh, the market was very excited. Let's visualize what Romaine was talking about. This is intraday moves for the S&P. This is where we sit right now. This massive range for the S&P where we were down earlier, and then a huge spike up by 7%. Now, a lot of you watching weren't even in the market the last time we saw this kind of spike, and that was all the way back to 2010 during the financial crisis. And you can see here, we haven't seen anything of that magnitude, not even back in COVID, Romaine, have we seen this kind of thing. Now, you take a look at the SPY, for example. So that's the ETF that tracks the S&P. Shorts were already increasing. We hadn't seen these kind of shorts in about a year. So you could say, okay, maybe it's just short covering. But regardless, an historic move, no doubt.
Absolutely. One that maybe I think we'll probably be telling our grandkids about, because that's what we do here at Bloomberg. Kicking us off to the close is Barry Knapp, Director of Research over at Ironsides Macroeconomics. And Barry, I have to start off with the obvious question. Were you actually surprised at how quickly we saw the market rally on the back of that effectively social media post?
No, I wasn't. 6.5 weeks or so ago, we wrote a note cleaning up the industrial policy mess, which was a version of what Scott Bessent described as Treasury Secretary Bessent, that is, of detoxing from the addiction of government spending. And our idea was, as government spending slowed, as we went through this awkward policy sequencing, trade before tax policy and spending cuts, that we were likely to see a decent pullback. 10 to 12% was our call. Obviously, it went beyond that. The tariffs were bigger than we thought. But over the weekend, and by late last week in particular, we made the decision that we'd pretty much fully priced the risk of a recession, that measures of volatility, the VIX, the VVIX, the term structure, the VIX futures, all those things were priced for an extreme event. and that the policy outlook was likely to bottom out, that it just wasn't going to get any worse, that we thought it was time to take a stand and put some money to work. So, it's obviously been a really hairy couple of days with having made that call. But no, I think this all makes sense. My explanation for why they pivoted, Bessent would lead you to believe that this was the plan on Sunday. And to be fair, we thought we'd wind up with a 10% baseline tariff. And we'd start negotiating with everybody but China. But that said, what's going on in the Treasury market, and one of the things we were concerned about in our note this weekend was that the trade policy could derail what we consider to be the absolute utmost important policy initiative, which is cutting government spending and getting it back on track to 20.5% of GDP. It's the only way to stabilize the debt and deficits.
Well, I'm sorry, Barry. When is that happening?
Oh, please.
But when is that happening? Because this has been a big topic of conversation over the last few weeks as we focus on tariffs, and prior to that, all the DEI nonsense here. We had a president who ran on a policy of being pro-business, deregulation, cutting spending, and getting the budget in some sort of order here. That seems like that was on the back burner as he dealt with these other issues. Do you have confidence now that he, and more importantly, Congress, are ready to tackle this?
Yeah, it's a great point. So my policy priorities as an investor is, number one, cutting spending, getting it back on track to 20.5% of GDP. It's 50-year median level. Number two is pro-corporate supply-side tax policy, reinstating immediate expensing for equipment investment, R&D spending, those initiatives. And then number three is deregulation of the energy and financial sector. Trade policy is really on the low end of my list. Obviously, President Trump got elected partially in 16 and 24 because of that particular issue. So that's the Main Street, Wall Street dynamic. But what I think happened over the last couple of days, Romaine, is, it's a little bit arcane, but one of the trades that was very big with the hedge fund community and bond community was the so-called Bessent put. And it was swap spreads, this idea that swap spreads would tighten relative to future, or relative to cash, and we would get because of less.
Hey Barry, hold that thought for just 1 second. We do want to go and listen to the president right now speaking outside of the White House.
China wants to make a deal. They just don't know how quite to go about it. It's one of those things they don't know how quite. They're proud people, and President Xi's a proud man. I know him very well, and they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal. And we have many other countries, as you know, many more than 75, and they all want to come, and they want to come here, or they'll go to Commerce, or they'll go to Treasury. We have our great senators here and congressmen. They'll call John, they'll do somebody, they'll go through somebody, but they're all calling, how do we do this? They all want to make a deal. Somebody had to do what we did, and I did a 90-day pause for the people that didn't retaliate, because I told them, if you retaliate, we're going to double it. And that's what I did with China, because they did retaliate. So we'll see how it all works out. I think it's going to work out amazing. I think that our country is going to be at the end of a year or shorter, but I think we're going to have something that nobody would have dreamt possible. A man like Roger Penske, I don't want to get him in trouble with China, so I won't, but he would know that someday you have to cut the bow, and you have to do what you have to do, right, Roger? And that's what I did, and I'm very happy to have done it.
The Prime Minister of Greece just told Breitbart's Matt Boyle that he thinks absolutely the European Union and the United States could work out a trade deal that's win-win and, quote, mutually beneficial to both sides.
I agree.
What do you think about the Prime Minister's comments, and do you think a deal could be struck with the European Union?
First of all, I know him. He's a good man, and I appreciate his comments. Yeah, a deal could be made with every one of them. A deal's going to be made with China. A deal's going to be made with every one of them. And there'll be fair deals. I just want fair. There will be fair deals for everybody. But they weren't fair to the United States. They were sucking us dry, and you can't do that. We have $36 trillion of debt for a reason. We don't have it there for fun. They have it for a reason. And people took advantage of our country, and they ripped us off for decades. I've been thinking about this for decades. If you ever saw me on television, I was young like these guys. And it was a good old days, I'll tell you, Roger. But I was like these guys, young, and I was talking about it. Nothing changed, and nothing was done about it. Then I did it. In my first term, I did it, and did it well. We took in hundreds of billions of dollars from China and others, and I started the process. But then we had to fix up from the COVID mess caused by China. We had to fix up from that, and we did a good job of doing it. And when we handed back the reins after a rigged election, and when we handed back the reins, the stock market was higher than it was before COVID coming in. So, you know, we did a great job, but we didn't have time to do the big thing, which we're doing now. And it's, you know, it's like a patient is sick. You have to do surgery. Patient is very, very sick. And Joe Biden handed us over a country that was in very serious trouble, economically and in every other way. They let China run away with things. They let other countries run away with things. And maybe worst of all, in a certain way, is what they did at the border. We had people pouring into our country by the millions. Many of them were murderers and drug lords and thieves and people from prisons from all over the world. And they were people from mental institutions, insane asylums. They were taking their mentally insane, and they were dumping them into our country. And I'll tell you, Tom Homan and Kristi Noem are doing a fantastic job in removing them. And now the courts, the Supreme Court just gave us numerous good rulings where we have to be able to get them out. You had other judges trying to take over the system. And think of it, they take over. They want these people coming back. Trent from Venezuela, the Venezuela jails that cut off the fingers of a man in Colorado. They cut off his fingers because he called the police looking for help. They said, "Did you call the police?" He said, "Yes, I did." "Put your hand down," and they cut off the fingers. This is what they want to bring these people back now. And I want to thank the president of El Salvador for the job he's done, because that is that's the way it has to be done.
Mr. President.
Yeah, please.
Chuck Schumer and Nancy Pelosi, they've been talking about tariffs for decades.
That's
How
right.
come when these Democrat elites want tariffs, everything's hunky-dory, but when President Trump wants tariffs, all hell breaks loose? Do you see this double standard?
I love this guy, whoever the hell that is. That's really nice. I appreciate that question. No, Chuck Schumer and Nancy Pelosi, everybody knew you had to do it, but they never had the guts to do it. It does take guts. It even takes guts for our country to go through it. That's why I say be cool. They were saying about, I said, just be cool. It's going to work out. It's going to work out, and it's working out. I can tell you, working out maybe faster than I thought. But I said it's going to take a little conditioning. It's a transition to. It's really, I think it's a transition to greatness. It's going to be greatness. Our country is going to be. There'll be nothing like it, and people investing in our country, they're going to do better than they've ever done before. We have more car manufacturers, Roger, coming into our country now. Speaking of cars. We've never seen anything like it. And they're coming in because of the election, but they're coming in because of the tariffs, because they don't want to pay 25 or 50 or whatever it may be. They don't want to pay that. They can't pay that. We had 3 cancellations in Mexico, building a plant. They're all coming into the United States. Canada, they're coming in. From China, they're coming in from everywhere. And that's just cars. We have chip makers come. We're the biggest chip maker in the world from Taiwan, coming in, spending $3 billion to build plants, and mostly a big plant. This is a hell of a plant when you spend the kind of money that they're going to go $200 to $300 billion, not million. You know, you'd say million would be the right number. It's not $200 to $300 billion. Think of that, $300 billion. If you look at Apple is going to spend $500 billion building a plant. They wouldn't be doing that if I didn't do this. They'd just keep building them in China. And that's unsustainable. It's not a pleasant thing to do, but I appreciate the question. And, you know, interestingly, Chuck Schumer and Nancy Pelosi, Crazy Nancy, they've wanted to do this for years, but they never had a president that had the guts to do it, because it does take guts, believe me.
Was it the bond markets that persuaded you to?
No, I was watching the bond market. The bond market is very tricky. I was watching it, but if you look at it now, it's beautiful. The bond market right now is beautiful. But yeah, I saw last night where people were getting a little queasy. think everything had, well, the big move wasn't what I did today. The big move was what I did on Liberation Day. We had Liberation Day in America. We're liberated from all of the horrible deals that were made, all of the horrible trade deals that were made. And I was helped by people just like this, senator, congressman, and friend, right? And we had great help in the Senate. Our Republican senators have been amazing. They stood tall. And likewise in the House. And John Thune has done an amazing job. Barrasso has done an amazing job. I mean, I can't think of a senator, really. We had tremendous support. We got a bill passed the other day with almost unanimous support in the Senate. And I think we're going to get that in the House, too. And I have to tell you that Mike Johnson is a great speaker. He's done a fantastic job. We had a majority of 1. Now we have a majority of 7. And you don't realize how big 7 is until you have a majority of 1. And 7 sounds like so much. But we're doing well. But Mike Johnson and John Thune have done a really great job.
Mr. President, was there anyone who influenced your decision? Did you speak with anyone? You know, Jamie Dimon? Did you speak with anyone?
Well, I watched Jamie Dimon on Maria Bartiromo's show this morning, and he was very good. He said that actually made the statement to effect that something had to be done with the tariffs and trade. He said that. He said, look, you know, at some point, but he said something has to be done with tariffs and trade. He understood it. He's very smart, very genius financially. He's done a fantastic job at the bank. And he knows that. Everybody knows that. Anybody that's even a little bit smart knows it. It wasn't sustainable what was happening. Somebody had to pull the trigger. I was willing to pull the trigger. This should have been done long ago. Just like Biden should have stopped the border long ago. I mean, allowed 21 million people plus into our country, many of whom should never have been allowed out of prisons and jails. They came out of prisons and jails from all over the world. And now we're getting them out, bringing them back to their countries. But it's should have never been done.
And where does the TikTok decision stand?
Yeah, go ahead, please.
Sir, would you consider exempting some U.S. companies, maybe some larger companies who have been hit hard in the markets last few days?
Well, I'll take a look at it as time goes by. We're going to take a look at it. There are some that have been hard. There are some that, by the nature of the company, get hit a little bit harder. And we'll take a look at that. Yeah.
How will you determine that over the next 90 days?
Just instinctively, more than anything else. I mean, you almost can't take a pencil to paper. It's really more of an instinct, I think, than anything else.
Mr. President, of all this, what is your credibility like? Because you said that these tariffs would go into effect on Monday. You said no pause. Today there is a pause. So,
no, I think you have to have. It's not a question of that. You have to have flexibility. I could say, here's a wall, and I'm going to go through that wall. I'm going to go through it no matter what, and keep going, and you can't go through the wall. Sometimes you have to be able to go under the wall, around the wall, or over the wall. These guys know that better than anybody, right? You got to go around them sometimes. You're not going to go through them. So I consider, you know, I think in financial markets, because they change. Look how much it changed today. We went from, you know, pretty moderate today, but over the last few days it looked pretty glum, to, I guess they say it was the biggest day in financial history. That's a pretty big change. And I think the word would be flexible. You have to be flexible. Like he's asking the question about some companies. Some companies, through no fault of their own, they happen to be in an industry that is more affected by these things than others. You have to be able to show a little flexibility. And I'm able to do that. I'm going to say hello to these champions because they are great champions. I got to say.
Mr. President, plan to talk to Xi Jinping.
Thank you, Mr. President.
To avoid more escalation.
You've been listening to President Trump speaking on that 90-day pause on countries that did not retaliate. A couple headlines coming out here. He thinks the bond market is now beautiful. He was watching the bond market. He will take a look at exempting some U.S. companies from tariffs using instinct. Also talking about China, that China did retaliate and that China is in the process of figuring it out, and that China doesn't know how to go about it yet, but that China does want to make a deal. Want to get more on this from Mike Froman, president of the Council on Foreign Relations. He also worked in the Obama administration on trade as well. Hey, Mike, really good to get your perspective. Where does this leave China?
Well, I think the good news is that the president articulated a willingness to be flexible, to exempt certain companies, albeit by his own instinct and to negotiate. And there's been a lot of confusion up to now with some members of the administration saying there will be no negotiations, these tariffs are permanent, and there won't be any exemptions, to now the president saying the opposite. So I assume that will be the policy going forward, at least for now. With regard to China, whether it's a 50% tariff, 100% tariff, 125% tariff, at some point the tariff is prohibitive, meaning you won't import the good at all. And that means Americans who rely on those goods will either have to find them from somewhere else, whether they're produced domestically or from other countries, or do without. And we've already seen some manufacturers saying they're going to have trouble getting the parts or the inputs they need to continue, and it may force them to shut down their business. So there we have to see how that gets resolved. The Chinese have listed a long group of products to retaliate against, including many in the agricultural space. Last time this happened, the U.S. government ended up subsidizing farmers for the losses that they suffered from retaliation. They collected about $70 billion in tariffs from China and gave about 92% of that back to the farmers. We'll have to see whether that happens with farmers or other affected industries going forward.
So when we talk about, Mike, the negotiations that could potentially come, and I definitely put could up there as a huge qualifier, who are the main nations that you think will sort of be first in that queue to try to strike a deal over these next 90 days?
Well, look, I think as the president and the administration have said, there's a long line, whether it's our neighbors, Canada and Mexico, Japan, Korea, the EU, Australia and others, where we actually have a trade surplus with Australia, and they still have a 10% tariff that they're facing. They all want to try and reach some sort of negotiated solution. The EU announced retaliation, but they'd really rather not implement it if they don't have to, because they don't think it's good for themselves or for the United States. They'd like to try and reach some sort of agreement. The question is, what is the president willing to negotiate? Because if the result is a 10% tariff, so we get rid of all the extra so-called reciprocal tariffs, but we end up with a 10% across-the-board tariff, that is a 500% increase in the current tariff rate. Countries like Venezuela, North Korea, and Iran have 10% tariffs. Those aren't known for being the most successful, wealthiest countries. And so I'm not sure, while the markets may view that as a very positive sign, that we're only going to have a 10% tariff, that is not a great place to end up.
Well, positioning definitely offside, contributing to the massive market reaction that we've seen. Mike, when we talked about exempting U.S. companies from tariffs, and President Trump said he's going to think about that and do that on instinct, how would you do that? Like, if you were going to put pen to paper, how does one manage that?
So normally when there's a trade action of this sort, there's a process where people can come into the U.S. government and make their case, and they submit for the public, and the public can see all of the requests, what their call for exemptions are, and then there's a process led by the U.S. Trade Representative, Commerce, the International Trade Commission, where they review them and figure out who really needs an exemption and who doesn't. The risk is you sort of leave it to special pleading, so whoever has the best access to the White House may get exemptions while others may be left behind. And oftentimes it's small businesses who aren't very well organized, don't have the kind of clout in Washington that big corporations do, and who are going to be adversely affected and need those exemptions. And the key thing is how to create a process where they can participate as well.
I do wonder, Mike, given that this clearly is unresolved, and you make a good point with those 10% tariffs effectively being new, because let's face it, they weren't there a little while ago, it raises the question as to how businesses, and particularly those small and mid-sized businesses, even sort of plan for what's next. I mean, if the president can sort of change his mind on a dime like he did today, why am I to believe that somehow he won't reinstate some of those more extreme maximum tariffs, as Scott Bessent put it?
I think that's a very good question. And this uncertainty, if you're sitting in a boardroom, or even if you're just a small business trying to figure out, do we deploy capital? Do we try and open up production in the United States? You're looking for some degree of certainty, because those are expensive decisions. They take a long time to relocate your supply chain, to build out factories here in the United States. And you want to know that what the regulatory environment is going to look like. Is it going to be 10% across the board? Will there be peak tariffs? If he's going to be flexible and some industries are going to be exempted, you're going to want to know whether you're exempted before you make any decisions. So one of the challenges of being flexible is that it creates more uncertainty, and that uncertainty may well delay the kinds of decisions that the president is looking for in terms of reshoring production back to the United States.
Mike, really appreciate you taking time for us. Mike Froman, a wealth of knowledge, president of the Council of Foreign Relations, and of course, formerly working at the USTR under the Obama administration, as we keep an eye on what is a breathtaking rally here with the S&P up 9%, the NASDAQ up more than 11. The worst case scenarios that were being priced into this market just a few hours ago, now apparently being priced out. Torsten Slok joins us right now, chief economist and partner at Apollo Global Management, on a day, or quite frankly, and we should point out, Torsten, on a day where we came in, where we still had a lot of folks on Wall Street predicting recession. At least a couple of those folks on Wall Street over the last hour or so have rescinded those recession calls. Is recession still a risk?
I do think that recession risk has been removed now, because it ended up that this shock was a lot shorter than what we expected just a few hours ago. What, of course, is still very important is that there's still uncertainty about what will happen in 90 days. As Mike Froman also was just saying, there's also uncertainty about the 10% tariffs. What would that still imply in terms of the impact? And there's certainly also uncertainty in terms of what is the impact of tariffs on China of this significant magnitude. Let's not forget that surveys show that sellers on Amazon, you have about 70% of them, they source their goods in China. So that means that there's a significant amount of price increases coming on a broad range of consumer goods coming into the US. So now we all in the economics profession have to go back to our spreadsheets and try to quantify what that means for the growth outlook. And it's clear that the implication is that there is likely to be still some negative outlook for consumer spending.
Yeah, Torsten, to your point, Bloomberg broke the news that Amazon actually canceled some orders for like scooters, deck chairs, things like that because of tariffs. Why is recession taken off the table? Because this doesn't remove any uncertainty. It just provides, if we believe that, a floor and a top for potential tariff risk.
Well, that's right, Alex. And I think you're absolutely right. I do also think that markets will still have this cloud hanging over it with saying, well, what about capital markets? What about loan markets, IPO, M&A? We'll probably still have some level of uncertainty around, okay, so maybe there may be a window now where markets could open it up a little bit in terms of financings, but the risk is still, broadly speaking, that if there is still uncertainty about what is coming and what might the implications be. And even when these deals begin to come out, are we going back to the level of tariffs that were in place up until here now a few hours ago, in particular against a lot of different countries that are the major trading partners, such as Canada, Mexico, and Europe. So you're right, uncertainty is still elevated, but let's just agree that it's significantly lower than what it was before. So I still think that overall, this cataclysmic risk of a recession in the very short term is no longer the case.
Well, how are financial conditions, Torsten? And I know that that's probably a question that changes depending on what day of the week I ask. But we came into today where we saw a huge amount of foreign selling of U.S. debt, a huge amount of foreign selling of the dollar. And it was raising a lot of concerns about liquidity or the lack thereof that we've been seeing in the fixed income and FX markets, and the potential for another blow up akin to what we saw in that carry trade blow up in August of last year. Is that still a risk?
That's a very important question, Romain, because exactly if you look at the rates reaction after this 90-day delay come out, you saw that short rates have gone up a lot. But short rates have come down a lot, but long rates have not moved that much. So in that sense, it is a very significant development that there are some important differences across the yield curve in terms of how markets have responded. So you're right. The change that we have seen in financial markets, especially this unique feature in the last few days where the stock market was going down, and exactly as you're highlighting, interest rates were going up. That is something that, of course, has created a lot of attention to why was it the case that financial markets suddenly saw what looked like forced selling, where someone was forced to sell long-term treasuries. And exactly as you're saying, watching what the dollar is doing is particularly critical, namely to watch whether is this foreigners selling, is this domestic investors selling. So now markets will settle down now for the rest of today at probably levels around where we are at the moment. But watching exactly what is the response from foreigners and from domestic investors will become very important.
Yeah, and like you said, the move is really in the 2-year today. The back end not moving that much necessarily on this news. Hey, Torsten, last question. Did the markets win?
Well, so that, of course, as usual, depends on what side you're on in the market. But I do think at least that it must be a huge sigh of relief in markets at the moment. At least it looks like now we have more steady pace of negotiations coming. You could hope that there will begin to be some negotiations with Canada and Mexico first, so that could be settled, and then other parts of the world will come subsequently. So the more clarity there is in markets about what is the sequencing, what does it look like when deals come out, I think that will be most helpful for markets in terms of some of the fogginess that we've been going through here more recently beginning to clear.
Torsten Slok, chief economist over at Apollo, as we keep an eye on the broader markets, not right around near fresh session highs, and some of the biggest gainers today in the S&P 500. Airlines, that includes Delta, up more than 20% after posting an earnings report that, well, not great, and of course guidance that was also pulled, but a lot of folks did find some encouraging statements out of the CEO. Stephen Trent joins us right now, equity analyst and managing director over at Citi, has a buy rating on Delta and a price target of 7,200. And Stephen, we should point out, the stock was already rallying even before the Trump tariff comments. It was up like 8% and then got a nice boost after that, up to 20+%. What was your reaction to the earnings report, and more importantly, what Ed Bastian had to say about the business? Why did we see such a positive reaction?
Yeah, and thank you for having me on. So I think the earnings report, all things considered, was pretty good. Mm-hmm. We saw, for example, the booking curve showing some strength after you did have a dip on the Liberation Day announcement. And with the exception of domestic main cabin, the verticals overall look pretty good. International strong co-branded card remuneration. And I think that the street had some rightful sympathy for the suspension of the guidance, given the great lack of uncertainty. Now a little bit better, maybe. But,
I was going to ask, would their call have been different if we had gotten this announcement before their earnings call?
I'm not necessarily sure it would have been different per se. I think perhaps the early reaction and the early price action could have been even stronger. But I think we move down 90 days from now and what happens, that's still a little bit up in the air, no pun intended. I also think that when one looks at the asset price reaction today, we're probably going to see some consumer reaction with a delay. So when we look at sort of the broad picture, I'm not 100% convinced that domestic main cabin is suddenly going to boom. But they've been doing a very good job on all the other verticals, and that's been enough to move the business forward.
So this sounds like it's more about good management execution rather than a good operating environment.
Absolutely. I think this is really good execution on Delta's part, and it's certainly not their fault we've had all this uncertainty with respect to policy coming out of Washington, which does create some difficulties in consumers trying to plan discretionary spending and companies trying to plan investments for the year. But they've done everything they can, and I think they've done a really good job.
Do you have optimism about the other U.S. airlines, carriers, when they report?
So we're constructive on the network airlines. And I think if you look at the lower socioeconomic strata, that segment's been under pressure. I'm not necessarily sure that comes off, but I think if you're a network airline, looking at the paucity of new equipment per capita, there's ability to put that into price. And if you're a discount airline, it's a little tougher road.
All right, Stephen, thank you very much. We appreciate it. Stephen Trent, equity analyst and managing director over at Citi. All right, let's get more insight now into the bond market as you have equities fly and you have the front end yields just popping as well. Stephen Laipply is global co-head of iShares fixed income ETFs over at BlackRock. What a day to have you join us. What has volume, what has movement been like in the past hour and a half?
It's been pretty incredible. You guys have seen the whipsaw in equities, and then we also had a bit of that on the curve too, particularly at the back end. So we had some retracement of yields in the back end. We're still elevated, kind of in the front and the belly, but it has been quite a volatile day. And I would say in general, the week has been something else, and we've seen very, very powerful volumes on the back of this, record-setting volumes in bond ETFs in particular.
Well, prior to today, where was the money going, or where was it maybe not going?
Well, I think the trend has actually been fairly up in quality. So, this year we've taken in around 30 billion, 31 billion in the U.S. In iShares bond ETFs. Over half of that's been in treasuries. And the majority of that has actually been in the very front end of the curve, SGOV, which is our T-bill fund. So there's been a lot of flow into quality. The second, I think most popular category would be multi-sector investment grade and just pure corporate investment grade. So it's been an up in quality trade.
Well, speaking of that, we had started to see the high yield and investment grade market really, the spreads really start to widen out and move.
Yes.
Clearly, that's been rerated a little bit in the last hour and a half. What have you noticed in terms of flows and sort of risk on risk aversion?
Yeah, so we did obviously see a lot of spread widening in high yield the last few days. I mean, I think we were at about 125 basis points, which is a lot, about 25 in investment grade, and some of that's retraced today. We did see high yield outflows in ETFs. Investment grade's a little more mixed, but probably you'll see some of that snap back after this reprieve.
I am curious. There was a lot of talk, particularly during the last few days where we saw this huge uproar in markets, that a lot of investors, particularly on the retail side, were actually utilizing ETFs more so than they were utilizing any other instruments, whether it was single stock or indexes or anything else. Do you think that is sort of a ratification of your job, congratulations, but more importantly, just a ratification of the structural shifts in this market, and that is something going forward we should also look to, maybe a little bit closer to for signals going forward?
Well, Romain, I think that's exactly it. I think it's not only retail. So what we've noticed, we saw this during March 2020 as well. Even in the treasury market, right, the most liquid market in the world, you're seeing institutional investors trade bond ETFs for risk management. So TLT, as an example, prior record was during 2020 was around 13 billion in a single day. Just traded 10 billion the other day. HYG, our high yield fund, set an all-time record on Monday. It was around 14.4 billion. That represented actually about 60% of the entire over-the-counter volume in the high-yield market, which is an incredible stat. And it just goes to sort of show just how much these products have become ingrained into the markets, particularly in credit.
Before I let you go, have you noticed anything, any signs of liquidity stress or anything in the Treasury market that we need to be worried about here or thinking about?
Well, there was obviously a lot of discussion around, the back end of the curve and swap spreads and all of that. I don't think we particularly saw a lot of funding stress. And again, in Treasury ETFs, they were functioning very, very well, high volume, tight spreads. So, it seems to have held up very well.
Yeah, and I just want to point out, too, I mean, that on near record we saw on TLT the other day, and we should also point out Monday we did see record volumes. Right now, looking at volumes on TLT, looks like we're going to surpass that record on a volume basis today. Stephen Laipply, global co-head of iShares fixed income ETFs over at BlackRock, as we keep it moving towards the market close, setting up for what could be one of the more monumental closes in the history of this market, certainly one of the biggest turnarounds. Mark Newton is managing director and global head of technical strategy at Fundstrat Global Advisors, and he joins us right now. And Mark, of course, there were a lot of technical levels breached over the last few days that set up the possibility for this sort of snapback that we're seeing today. Did you expect it to be this strong?
No, I don't think anybody expected it to be that strong, Romain. Thanks for having me back here. Look, 4,800 was a very key level for the S&P. That is 50% of the entire move up since 2022. And just in the last few days, we had seen real evidence of not only breadth being washed out, but substantially lower conditions in terms of momentum being quite oversold as we've been in years. And to follow that with a move of this magnitude off the lows, we have about a 30-to-1 ratio right now of volume to the upside. That is extraordinary. And so, we also see obviously some comfort being seen also in the basis trade and those spreads coming in a little bit, after having been tightening earlier in the morning. So honestly, I think the basis trade very well could have forced Trump's hand, and I don't think it's wrong to think that based on what's happened just in recent days with yields. But we certainly had the conditions in place towards thinking that a low should be near. I think today is the first step of that process. I can say pretty confidently, I think breadth has made a bottom. As to whether equities pull back, I'm unclear. It's always tough to buy a 10% move up when trends and momentum are so sharply down. But I'm pretty confident that we're in a bottoming process here.
Okay, because this was my question. Is this a dead cat bounce? Are we still going to be in a downtrend, right? It might remove recession risk, but there's still a lot of uncertainty. What do you have to see to get confidence in the uptrend?
Well, I think we saw several measures of fear turning into capitulation just this past week. I mean, yesterday we saw the ARMS index hit a 3.43. That is extraordinarily rare. We saw almost all the volume to the downside. Normally that does happen right near bottoms. We saw the equity put to call just back on the 3rd of April hit 1.03. Those are classic measures that normally happen to suggest that, this move is getting washed out. Even in the recent days, evidence of tariffs not really affecting the market as dramatically were apparent with almost a 10% move off the bottom just this past Monday, and then the backing and filling. So what do I need to see to be confident? I think that takes time. Obviously, when momentum, breadth, and trends are so sharply negative, it's tough to buy the bottom. But honestly, there are some things in place to suggest markets should bottom in April. Cycles, sentiment, seasonality, momentum, breadth, all those are giving good signs, as well as technology to that matter. Tech, on a relative basis to the S&P, has pulled back and hit long-term uptrends. The Mag 7 is having one of its best days today that it's had in the last couple of years. I think that is extraordinary. For me, that gives me some confidence at a time when tech is much more reasonable right now in terms of valuation. And it's still the largest profit center for the S&P this year at about 25%.
But there were some people that were looking at the drop in valuation, at least the drop in multiples because of the sell-off, and saying, look, if you go by historical standards, we're nowhere near that sort of nadir that you would typically look to as a sign of capitulation. Assuming that we did skirt that nadir, what gives you the confidence, Mark, that this rally that we get today, to Alex's point, can indeed persist?
I would say a couple things, Romaine. And one is that just the breadth and the volume is so strong to the upside after evidence of technical capitulation in recent days. That gives me some initial confidence. The S&P getting over 5,500, that's really the big sign now on the upside that every technician is going to be looking at. Getting back above that will give you pretty good confidence that we can get back to new highs. I'm unable to say that just yet, of course. And I think that any bounce in the weeks and or months to come really has to be analyzed for evidence of participation, structure. All those are important in terms of what kind of a bounce we see. There's evidence that there was going to be a low. As to how we rally now, that's the next question in the weeks and the months to come.
Hey, Mark, before I let you go, how do you look at the long end of the bond market? I mean, we're only down 2 basis points on the 30-year, despite being up 20 on the 2-year.
Yeah, we've seen a remarkable steepening in that curve, obviously, in the last couple months. When we broke through the zero line late last year, and that's just continued. The move over 42 basis points this week caused a real acceleration higher. And so, tough to say that we're going to see a severe flattening just yet. I think the bond market's going to prove a lot choppier in the months to come. I don't mind being long treasuries after one of the largest backing up in yield on a 3-day basis that we've seen, I think, since 1982 on the 30-year, almost a 50 basis point move. So if anything, if investors are still worried that the market hasn't bottomed yet, treasuries to me make excellent sense. My cycles actually go down in yields between really April and later this summer. So I still think you can make money in treasuries, but I would much prefer equities on a 12-month basis given the deterioration we've seen.
All right, thanks, Mark. Really appreciate it. Mark Newton, Managing Director, Global Head of Technical Strategy at Fundstrat Global Advisors. Bill Gross disagrees. He says, do you want to own highly volatile U.S. stocks whose price depends on whether POTUS has a good night's sleep and woke up the next morning to reverse yesterday's policies? All right, let's get back to the economy and what this means. RBC Chief Economist Francis Donald is here with us in studio. Thank you so much for being here. We really appreciate it.
Busy day, lots to talk about.
Busy day. Has your call changed at all for the U.S. economy in the last 2 hours?
Well, we were actually in the process of putting out our next round of forecasts, but the good news is we haven't really believed in point forecasts in this type of environment. We've been focused on scenarios. So we do have scenarios that look at, for example, a 10% average tariff rate for the United States. And those ones are, it's not really a big surprise, less severe than a 20% average tariff rate, which is where we were just a few days ago. But I have to say, it's not like we're all in the clear. Even 10% tariffs, and let's put aside China tariffs for a minute, are still a material downgrade to U.S. growth. Doesn't quite fit the definition of a recession, but there's a lot of elements of the story that were still in play, and we're going to have to crunch those numbers. Weighing on me at the same time is a 90-day pause is not an eradication, and we still have this uncertainty tax weighing on a lot of American businesses and households, and globally, we know this, Canadians have been dealing with this for 2 months. 90-day pause also means that all of those global trading partners are also under the weight of uncertainty. So to me, last week, I thought America's cut off both its arms. Today, one arm.
Well, okay.
Fair enough.
Good description. Great analogy. I don't even know where to start with that. But it gets to this idea. You see the snapback in the market. Obviously, that does not necessarily translate to a snapback in business activity. Two things that jumped out at me. So obviously, you have the tariffs on China are still there and higher than what they were. I mean, they represent something like 17% of our global economy. The European Union, at least for right now, doesn't appear to be at the negotiating table. That's another 10 to 15% of the global economy. That's 30% of the global economy that, in theory, is not in the queue that Trump talks about. Yeah, it's great that Vietnam, Cambodia, Thailand are lining up. Are those countries going to move the needle should they actually strike a deal?
Well, details matter a lot here. So the team is, as we speak, crunching those numbers, running more scenarios around it. But what really struck out to me in the last couple of hours is you may remember we were told that those large reciprocal tariffs from Liberation Day, those were the peak. Those were the highest they could go. Today we heard from Bessent. Now we got the 10%. That's the floor under which they could go. So believe it or not, my set of scenarios and circumstances is a little bit more narrow now than it was before. So markets are second derivative type beasts. I'm a second derivative type gal. I now know that the available scenarios are lower, and that makes things just a little bit easier at the margin for economists, but also for markets.
Let's go to the floor part for a second. That 10% average tariff rate, is that worse for inflation or worse for growth?
Inflation. All the tariff scenarios that we run, they bring inflation up, and not just temporarily. So we hear this term transitory applied to inflation with respect to tariffs. Hey, you see the price jump up, but then the year over year, it declines over time. Our modeling tells us that inflation coming from tariffs is much stickier, especially because we were already in a 3% type of environment. What's more transitory is actually the growth shock. Most of the scenarios we look at, they're 2 to 3 quarters of pain, and then you start to see some improvement on the other side. But there's no question from our mind, even a 10% across the board tariff with China on top of it is still upward pressure on inflation in the United States. And recession or no recession, our biggest concern for the U.S. right now is not growth. It's the inflation side of the picture, which is too hot. It started too hot. It's only going to get hotter.
Does this put us back, though, in that stagflation scenario? Because we were talking recession, I don't know, just a few hours ago. And now, at least if that's removed, it doesn't sound like we're still going to see meaningful GDP growth. If that is the case and inflation is rising, then where does that leave us?
Well, recession is 2 quarters of negative GDP, a rise in the unemployment rate, a couple other boxes you have to tick. But markets, I don't think, really care whether you're at plus 0.1 or negative 0.1 for GDP. 10% across the board tariffs is still going to be growth negative and can flirt around flat growth. Now, on top of that, we have tremendous amount of market volatility that can weigh on sentiment. We also have this uncertainty that we know pauses investment decisions. So we're still flirting with a very difficult economic environment. Whether or not you get to check the recession or no recession box is really apart from the idea that growth is going to slow materially from here on down, and 2025 is going to be a hard year for GDP.
Do you think there's reputational damage to the United States? And I ask you this as a Canadian and a Canadian economist for RBC.
Well, what do we know? We know that now there's less certainty dealing with the United States, and that there are global partners across the entire world that are going to have to reevaluate what that trading relationship can look like. We've seen sentiment shifts. For example, Canadians. Why is the Canada story interesting? Because Canada was dealing with this back and forth, pause, no pause, coming down to one sort of agreement about 2 months earlier. And what did they see? Huge drop in travelers towards the United States, a big push towards buying Canadian. Is that a template for how other countries might react? Possibly, but there's clues. And while all this might feel very new to a lot of trading partners in the last week, as I said, Canada and Mexico, they've been dealing with this for a couple months, so maybe there'll be stories that rhyme.
Yeah, we heard that from Delta, that there's been less trade between Canada and the U.S. in terms of travel. All right, thank you very much, Francis. We really appreciate it. Francis Donald, RBC Chief Economist. Let's go to these markets, Romain, because we have tech ripping. You have the NASDAQ 100 seeing the biggest gain since 2008, driven in part by the Mag 7. The superlatives just keep coming, whether you're looking at Apple or NVIDIA or just the big cap tech.
And it's hard to even sort of sack up the superlatives because the superlatives are everywhere. But I would just want to go on an individual basis, and you talk about the rebound that we've been seeing in names. I thought the rebound in Apple was probably most significant because everyone said this was kind of the one stock that was really right at the center, in a bad way, of this trade war here. The China risk isn't removed. It's still there. In fact, the China risk is probably higher, but you're seeing that stock rip by 15% here on the day. Meta Platforms up a similar amount. Tesla rallying about 22%. And then all those bank stocks. Remember, we get the bank earnings starting on Friday, although we did hear from Jamie Dimon speaking to Maria Bartiromo, or was he speaking to someone else? I don't know. But he gave some thoughts on the economy, and now he's going to have to show his cards on how the company performed last quarter, and more importantly, what it thinks they're going to do in the quarter going forward. But those shares up 8.5%.
And you can't dismiss any short covering here. I was mentioning earlier that the SPY, the SPY, the ETF that tracks the S&P, has highest short interest in about a year. And so cover that. There you go.
The VIX went from a high on the day of around 58 down to a low right now of around 32. The bond market's been all over the place. You're seeing yields higher on the short end, yields lower on the longer end of the curve. And keep an eye on the dollar, because that is a real barometer for how folks feel. The Bloomberg Dollar Spot Index still on a slide. Scott Chronert joins us right now, U.S. equity strategist and global head of ETF research over at Citi. All right, Scott, we talk about a rebound that I guess is deserved given what the president took off the table. How much stock can you put in that in terms of seeing some persistence to this rally, if not over the next 90 days, even beyond?
Well, I think you can put some stock in it. I think, we've been looking for an off-ramp to what was announced with Liberation Day. And so remember, the negative aspect of the 20% plus tariffs that kind of came out of Liberation Day was this view that there was no apparent path to negotiate that. And so that it defined your maximum negative aspect in terms of what stocks were discounting on this uncertainty element. Now, what's happened, you've begun to alleviate that. And you have to remember that various components of the Mag 7 are down as much as, well, in Tesla's case, over 50% from 52-week highs, others down, 20 to 35%. So the opportunity for these stocks to snap back is something that has been in our playbook. We went overweight tech going into Q2 just a couple of weeks ago, led by an upgrade to software alongside semis. We had been underweight hardware, which was the nagging China concern on Apple. That moves to the sidelines, but not completely for now. But what I would say here is that the degree of the negativity, the valuation disconnect, the underlying AI-related spending tailwinds that are still at work all make us of the view that this mega cap growth, tech-led bias, we think probably persists in the short term.
I am curious about the other end of the spectrum, Scott. We're seeing a pretty massive rally today in some of the more economically sensitive sectors. Dow Transports as a group up about 10%. The Russell up about 9% as well. Mid caps also up about 8 or 9%, Scott. Do you think there's hope there for some of those companies that really weren't directly exposed to the trade and tariff risk, but maybe they were exposed to the potential domestic economic risk?
Yeah, so look, the way we would talk about the playbook, we would kind of lean in with this growth bias. It's been our view because we haven't, to your earlier discussions, haven't completely eliminated the economic concern that's been going on even before we got to last week's Liberation Day. That's kept the small cap part of the market at bay, right? And so I think we need to get a little bit further, probably the other side of the Q1 reporting period, get a little bit more confidence that we're seeing a bottoming in fundamentals that we had not found yet anyway, before we kind of come back to that part more aggressively. But clearly, anytime you breathe a sigh of relief on underlying economic activity, small cap's going to feel that leverage. We still feel like, from our perspective, is that playing this growth narrative, I think, where you still have very, very visible free cash flow generation component at work here, combined with secular tailwinds, is probably still the best trade in the short term anyway.
So, Scott, to be clear, it doesn't seem like you've changed your call at all in the last 2 hours.
Correct. I mean, the playbook that we laid out going in, we were obviously pretty nervous about it as we went through Liberation Day, but we kind of stuck with this view that growth is defensive is a theme that you want to be on. We haven't completely eliminated that economic valley that might potentially be out there. It's the depth of it's probably a little bit less than it was, but our playbook is still pretty much intact.
If we keep high tariffs on China, though, and vice versa, does that disrupt things? I mean, you're talking about Apple, and that was really the poster child for trade issues between the U.S. and China, and that ripping higher today, even though those tariffs are still on.
Yeah, I think, Alex, I mean, it certainly does. But I think what the market's taken its cue from here is that, OK, great, we've gone back with another round of tariffs on China. But, with the messaging you heard from Secretary Bessent is that we got the trade conversation where we wanted, and that's where we get countries to negotiate. And so I think the markets, in looking at the Apple action today, is presuming that okay, great, it's going to take a little bit longer with China, but some presumption that ultimately we'll get there.
I am curious, though, Scott, too, about the earnings season that is basically kicked off today. We got Delta Airlines this morning, and as expected, the CEO there pulling guidance. We're heading into an earnings season where these companies and executives are going to be peppered with questions about how they see the rest of the year. Even given what's transpired today, Scott, do you think they will be able to articulate some degree of guidance, even if it is a broad range?
You know, Romain, it's a good question. I think we've been prepared that there's going to be a combination of pulling guidance, banding guidance, or being more firm on what you know and don't know around the outlook that would all come out in Q1, which we thought would lead to generally speaking, a negative revision bias. I've not been a fan of eliminating guidance. I think there's so much uncertainty in the market right now that investors want to at least to be able to identify sort of what a worst case might be. We did the same thing in our own work. We put out a thought piece over the weekend that was a hypothetical that said 4,700 on the S&P begins to price in what we think the full extent of tariffs would be. And what that really is intended to do is to provide a framework from which you can work back as the news flow unfolds. So I still think net, we're going to see a negative revision to numbers as we go through the Q1 reporting period. But I think we're probably going to see a little bit more nuanced perspective out of C-suites given today's action.
And I also just want to update our viewers here for 1 second. We are getting some additional headlines about the White House policy on tariffs. According to an administration official that Bloomberg reporters have spoken to, there is no change on the auto, steel, and aluminum tariffs, and no change to Canada and Mexico tariffs. That seems to dovetail with what Trump sort of alluded to himself a little while ago in his comments. But it gets to a broader point here, Scott, about how so much is still unresolved. And you've kind of touched on this idea. I mean, we still have to get whatever this queue of countries lining up to negotiate. Through that negotiating process, we have to figure out what two of the largest economies, or at least economic blocs in China and the European Union, are going to do as well. And then, of course, our own allies, Canada and Mexico. As you time this out here, Scott, is there some sense here that the markets won't be as forgiving if this drags on closer to that 90-day, we'll call it a deadline, if you will?
So we've been concerned on a couple of fronts, right? Let's just kind of start from.
Hey, Scott, I'm sorry. Scott, I have to cut you off, Scott. President Trump is now speaking once again, this time from the Oval Office. Let's take a listen.
You all set? Yes, sir. Thank you very much. Appreciate it. We just had a wonderful meeting with the greatest race car drivers in the world, and some really spectacular people that won the Indy 500 for the last, for the last 4 years, or last 2 years. And Roger Penske is so incredible. And the Daytona winners and the Daytona 24-hour champions. So it was really great to see them and to see those cars. Those cars are incredible. So there's a lot of winning out there, and we're having a good day in the stock market, as you can see, an all-time record day, and hopefully it continues. I think it should. Country's stronger than it's ever been, and somebody had to do that with, we had to take the medicine. We had to go through the operation, and that's what we've been through, and a lot of presidents would not have done it. No president would have done it, I think, but it had to be done, and I just want to thank my team, this team here, and lots of others, and Scott and Howard have been incredible, and for energy, there's nobody like this man, and for the roads and highways, boy, you've done well, Sean, so we appreciate it, very much appreciate it, and if we could, well, let's see, we're signing a lot of executive orders, and some ambassadors have been approved, yes, and we're going to start that process right now. We're honored to have Gretchen Whitmer from Michigan, great state of Michigan. And she's really done an excellent job, and a very good person. And we're working on the Selfridge, as you know, the air base. We're trying to get the air base open, keep it open. I think, Gretchen, if you're there, and Matt Hall, the Speaker of the House of Michigan. And he's been fantastic as the Speaker. I appreciate it. We won the state, Matt, and you helped me a lot.
I did, and you made me Speaker, so thank you, Mr. President.
That's good, too. And Gretchen, I think everybody knows. So we're working on that very hard, and I think we'll come home with a winner for Michigan, okay? I just spoke with the Secretary of Defense
Sometimes we call him the Secretary of War. It used to be called the Secretary of War. They changed it when we became a little bit politically correct. But I think we're in great shape. We're going to be in great shape. So thank you very much for being here. Thank you very much, man. Congratulations. Great job. So we'll start with the first orders. And I think we have one for a man named Mike Huckabee. Does anyone know Mike Huckabee?
Yes, sir.
He's going to be a great ambassador to Israel. And they're thrilled to have him, that I can tell you. Go ahead.
Yes, sir. So the Senate confirmed Governor Huckabee to be your next ambassador to Israel earlier today. That's his commission as ambassador. And then we also have a transmittal letter to the president of Israel requesting that he accept Ambassador Huckabee's credentials.
He's going to be fantastic. He's going to bring home the bacon.
And
even though bacon isn't too big in Israel.
That's just the third letter.
And you're listening right now to President Donald Trump signing executive orders in the White House. Of course, everyone right now focused less on those executive orders and more on what he had to say a little bit earlier today. A 90-day pause on some of those most extreme of the reciprocal tariffs or retaliatory tariffs, if you will, with, of course, one big caveat, and that is China. That set off a massive rally in the markets on today that will be full of superlatives. Romaine Bostick here alongside Alex Steele, Scarlett Fu joining us as well as she does every day at this time, and Scott Chronert at Citi still with us. We'll get to Scott in just 1 second, guys, but we have to talk about the numbers on the screen. A Dow Jones Industrial Average rallying 3,000 points or 8% on the day. An S&P 500 up about 474 points or 9.5%. That's the biggest percentage gain for the S&P going back to October of 2008, and that point swing from peak to trough is the widest on record. The NASDAQ Composite up about 1,800 points or 12% on the day, biggest one-day gain going back to 2001. And the Russell 2000 also rallying 150-plus points or 9% here on the day.
Yep, and taking a look here at the VIX, guys, this is an historic move in the VIX, a record move as we move through the day, Scarlett, with tech just crushing it, outperforming. Just take a look at those Mag 7.
You know what strikes me is the indiscriminate buying that you're seeing take place. FXI, the ETF that tracks Chinese stocks, gaining. EWC, the ETF that tracks Canada. EWW, the ETF that tracks Mexico, even though the tariffs remain on those countries.
I won't ask you what our pie chart looks like today, because I assume it's all green, Scarlett.
Pesto.
But I was going through all of the different sectors, not just the main S&P sectors, but all of the individual sort of subsectors here. And you're looking at monster moves. Transports up 10% here on the day. Bank stocks, when you look at the KBW Bank Index, up about 9% on the day. Software, application software companies, that's about 8 to 9% as well. Oil companies, Alex's favorite, up about 11. I could go on, but there was really nothing, at least on a sector, subsector basis, group basis, that was down in any meaningful way.
Yeah, and to your point, you have the steel companies as well, also gaining 10% as a group, even though we know that some of those sectoral tariffs do remain. So it's, again, a matter of indiscriminate buying that we're seeing take place. Even Johnson & Johnson, which had been down for most of the afternoon, has moved to the green side, up by 2/3%. It's definitely been a defensive name over the last couple of days, outperforming the S&P 500 so far this year.
Yeah, and talking about that record move for Mag 7, Apple, Nvidia, Microsoft, Amazon, Meta all jump at least 10%. Want to kiss on yields here, guys, because we also saw a very big move in the 2-year. At one point, it was 30 basis point swings, right? We haven't seen that since 2022. What was so interesting, though, is the back end did a whole lot of nothing. And that was where we saw all the signs of stress over the last 3 trading days.
It'll be interesting to see what transpires over the next 48 hours, of course, with earnings, another big treasury sale, and some economic data on the inflation front here that maybe could reshape the market narrative. Scott Chronert still with us over at Citi. Scott, thanks for being patient as we walk through these numbers, as we listen to the president. Definitely some optimism right now on this day with regards to where this market can go, but we'd be remiss in not pointing out we're still well off the highs that we had earlier this year, above 6,000. And I do wonder if you see a scenario, a bull case, best case scenario, where we could get back up to those 6,100 levels on the S&P 500 this year.
I mean, I think the positioning dynamic can work in your favor in that regard. I think it becomes a little bit more of a long shot, but it's still certainly in the line of sight. What I would say here is just a reminder, right? A lot of times with policy, it's not the what of the policy, it's the how of the policy. And I think what was so disconcerting for investors was the nature by which we saw the Liberation Day announcement hit. It just sapped the conviction level and the confidence that we knew what we were discounting from a fundamental perspective. And that has led to this underpositioning, negative positioning, and so forth. So as you come out the other side of that, you got to expect some relief, but we're still going to be looking at a tariff regime that's probably going to have some impact on fundamentals, which at the margin is going to make it harder to get back to the earnings growth expectations and the valuation for the market that was in place last time we were 6,100. So directionally, yeah, I don't doubt that we can't get there, but there are still some hurdles that we're going to need to contend with more structurally from a fundamental perspective.
Also, Scott, I can't help but notice the financial conditions have tightened considerably over the last couple of days. We don't have the final numbers from today's trade yet, but given that financial conditions are much tighter than they were a week ago, how does that make things more difficult for companies, particularly those that are highly indebted?
I think we got a little bit of time here for that to play out and potentially reverse a little bit off of today's action. I think, we've been watching the backup in spreads, for example, in the high yield market, and it's a little bit disconcerting that to watch that, but it also makes perfect sense as we go down, or the tariff path that we had been on might, to a certain degree, still be on. So I think one of the things that we're watching for here in terms of the tariff discussion, first order impacts, directly how you impact fundamentals. Second order impacts, the residual effect that might have in economic conditions. And I'd argue that the fundamentals are probably more important right now than inflation expectations. We can discuss that separately. Then the third order is unintended consequences. And that's where you begin to see individual companies run into, let's call it an existential issue as a function of the changing global landscape here. But I think it's going to be a little bit more segmented, if you will, than a broader, bigger issue that would align with the concern on financial conditions.
Hey, Scott, just take a look at Delta for a second. I mean, we've seen the biggest jump in Delta since 2008. And I'm just wondering, what are we learning about how investors are going to respond to earnings season? You pull guidance, your first quarter is pretty solid, and yet the stock has that kind of pop. What's our takeaway from that?
Well, it kind of goes back to this discussion on looking at how stocks have been acting going into the current situation. And, we pointed this out. The index, a while back was down 10%, but your Mag 7 down 20%. The airlines were down as much as 50%, right? So a lot of negativity getting priced in. And, the uncertainty breeds the negativity and breeds the selling. And anything that can provide a release valve to that, this is where you're going to get these significant moves to the upside, whether short covering or just a relief in terms of how the markets are pricing in the fundamental circumstance. Again, I'm not a big advocate of suspending guidance. I'd rather band where you think you're going to live, so that gives investors something better to manage and assess off of. But I think it just kind of goes to show on how far the rubber band had been stretched on the downside over the past couple of months.
I mean, if we assume for a second, Scott, that there is a little bit of life to this rally, is this going to be one of those stock pickers rallies where you really have to be very selective, or is this going to be that broad-based kind of a rising tide lifts all boats where you can just buy an index or ETF and sit back and enjoy the ride?
Yeah, so look, I think the bigger picture, Romain, is that we're going down much more of a stock picking lens. I think even though we're seeing the snapback in the Mag 7, the mega cap growth, tech, comm services component, which I'm completely a buyer of, I think that makes sense for a variety of reasons. I do think that we're not going to get back to the Goldilocks scenario that was in place beginning of the year, as I mentioned a couple of minutes ago. That's going to include the big tech component. So I do think what happens here is you continue to differentiate within the Mag 7. You continue to differentiate from a sector perspective. And then I do think as we go further into the Q1 reporting period, I think the stage is still set for a different approach to stock selection. Yesterday, I would have told you, let's find those companies that you always wanted to buy that seem too expensive, and now they're not. I still think we're going to be looking at a winner and loser bias in terms of how this plays out as we continue to navigate down a tariff path that's still out there, maybe not as onerous as it was previously, but it hasn't completely gone away yet.
Scott, always great insights, and really appreciate you sticking with us here on a really consequential day. One of the best in the business there, Scott Chronert, over at Citi on a monumental day. Our coverage continues here on The Close as we push ahead to maybe what keeps this rally going. And it was a historic rally by every measure. Depending on what index you picked, it was either, well, the best day since the pandemic, the best day since the financial crisis, in some cases, even the best day prior to that. An S&P 500 rallying 9.5% on the day, something, well, you don't see every day. The biggest point gain on the S&P, biggest point swing, I should say, on the S&P in history, and on a percentage basis from peak to trough, that would be the biggest point swing, percentage point swing, going back at least to the beginning of the global financial crisis. The NASDAQ up 12% on the day. And when you look at it on a sector basis, Scarlett, take a look at that. The Philadelphia Semiconductor Index. No index has been beaten up more than that. A rally today of 19%.
Yeah, pretty incredible breadth here when it comes to just how many stocks are gaining. I was looking at the most actively traded stocks by value. Of the top 100, there was only one that declined, and that was CME by about 1/3 of 1%. I was taking a look at some individual movers. J&J had been lagging the market all day long, and it does close higher, but not by very much. Remember, President Trump has vowed to impose major tariffs on pharmaceuticals, and J&J and some of those other healthcare names have outperformed the market by at least 8.5 percentage points so far this year. But for the most part, you saw indiscriminate buying, whether it was the ETF tied to Chinese stocks, the ETF tied to Mexican stocks. You could see the ETF tied to Canada stocks. Oh, no, that's Exelon. That's down 0.4%. The ETF tied to Canada stocks actually closing up as well. Apple's really interesting, too, because even though Trump is going to keep the tariffs on China, in fact, raising it to 125%. He did also say he will take a look at exempting some U.S. companies. And Romaine, as you know, Tim Cook famously negotiated an exemption for Apple in the first administration.
Yeah, and that's really, does that become market risk, though, Scarlett? Because we talk about a 90-day runway here, and now the question is who has the clout to actually negotiate
well said.
Something favorable. Maybe Tim Cook might have an edge there.
All right, well, we'll see how that all plays out. And, of course, everyone else is watching as well. In the meantime, we want to bring in our next guest. Jay Pelosky is CIO at TPW Investment Management. Jay, I hope your day has been okay for you with all this back and forth. I'm curious that once we get past this tariff noise, what still stands out to you as things that we need to address that have fundamentally changed because of the drama over the last 5-6 days?
Thanks, Scarlett. Yes, great to be on with a sea of green as opposed to a sea of red, right? And thank goodness for independent financial markets, which I believe bounded and forced the president and his team to reverse themselves pretty much across the board. I mean, you can talk about a 90-day pause and a 10% tariff that remains intact, but the reciprocal tariff, which was really the thing that people didn't get, tied to trade deficits, that's gone, and that's good news. And as far as the things that you have to think about that have changed fundamentally, look, I think this has been an immense own goal by the U.S. administration. We have basically proven ourselves to be not good partners, not good business partners. And I think that was reflected in the Treasury market and reflected in the dollar. And so for us, you know, we have been and continue to be of the view that we are early in a secular change of leadership away from U.S. equities, which have been the leader since the bottom in 2009, to the rest of the world, with the rest of the world having better policy mix, better execution, as well as cheaper markets and several other factors that we can talk about. And the big thing for us here is the dollar. We think we're early in the beginning of a capital repatriation out of the United States, back to Europe, back to Asia, back to the emerging markets.
Well, that's what I'm curious about, Jay, because there's been a lot of talk as to sort of what caused Trump to sort of make this pivot. And I know we can't get into outside his head. But when you look at all of the selling that you saw in the Treasury space, which seemed to be attributed to foreign buyers or foreign sellers, for that matter, but also more importantly, the sell-off that we had seen in the dollar, which still continued despite the rally that we saw in the market. Is that pressure coming from overseas? Is that what we're seeing?
Well, it's a key point, Roman, to note that the dollar was the one thing that didn't rally, right? Really?
Yeah.
And I think that's because we have damaged our credibility, and our story is not as good. We still have the uncertainty around tariffs. Clearly, we're going to grow less than we were a week ago before Liberation Day. And so the foreign investor base is aware that in Europe, their fiscal stimulus is much greater.
Yeah.
Their monetary policy, the ECB is going to cut next week. China is focused on fiscal policy to stimulate its domestic demand profile. Here in the U.S., I think, and we've written about this from the beginning, all of this is in service of tax cuts. And I think that why I said the Treasury was what forced Trump and team to back off is because we're going to switch the storyline to tax cuts. And the tax cuts are going to include a big fiscal deficit. And there's no way you can argue and articulate and make a case for a bigger fiscal deficit if your Treasury market is in flux. And so I think that is the factor that's turned the tide here, forced the president to step aside.
So the administration would argue that the tax cuts will be funded by the revenue generated by the tariffs, that it will balance out in the end, and it's in service to reordering the U.S. economy as a whole. Do you not see that happening at all, where things pan out in a way that the tax cuts are additive to the U.S. economy?
We just gave up the idea of revenue coming from tariffs. That idea is no longer valid as of whatever 1:30 or 2 o'clock today. So it's going to be a smaller number from tariffs. Some money will be generated. I've never believed that it goes from one to the other. It's a fig leaf, in my view. And DOGE, too, was meant to cut spending to provide more room for a tax cut. Because the basic bottom line here and why we're so bullish the rest of the world is that the U.S. shot its fiscal bullet post-COVID. And that led us to have the best growth, best corporate earnings, most highly valued stock market, most expensive currency in the world. That's now finished. Our budget deficit at 7% of GDP allows no room for fiscal stimulus. The rest of the world, Germany, China, budget debt as a percent of GDP, 65%. They have the fiscal space. They're going to use it. Their economies are going to grow, earnings are going to grow, stock market going to do better. So I think the president is going to be forced by the market to try to make a case for tax cuts that will be unfunded for the most part. And I think that you need a compliant Treasury market to even contemplate making that argument. And I think that's why we've made the change we see today.
So, Jay, kind of wrap this up for us here. This gets to a point now where we talk about whether you want to be invested in this market, or I guess maybe the better question is how you would want to be invested in this market. Based on what you just said, is that actually making a case for stocks, or is that making a case to be more defensive?
Well, we've been real clear again with our clients at TPW Advisory. We want to sell U.S. RIPs. And so this is today a RIP. We think you can probably look to get out of some positions and reallocate to the non-U.S. markets where we want to buy the dips, which is what we've been saying for the last couple of weeks. And it's really quite straightforward, right? Better fiscal policy mix outside the U.S., cheaper markets outside the U.S., better earnings growth, and completely under-owned. And the markets are telling us this. S&P prior to today, down 15% year to date. ACWI ex-U.S., so the rest of the world, down 5%.
Yeah.
Scarlett was talking about FXI, the China ETF. It's actually flat year to date and is the only one of the major ETFs that are above their 200-day moving average. So the U.S. has 5% or so to get back above its 200-day, which is around 57.50. I think we chop around here, but to us, the much better story, cheaper, less risk, better upside, benefit of a weak dollar is the non-U.S. equity markets. We like Europe, we like Japan, we like China, we like emerging markets, and we think Latin America could be starting to get interesting as well.
All right, Jay, got to leave it there. Jay Pelosky, founder and CIO over at TPW Investment Management, on a day where we saw pretty much every sector get a strong bid. That included the Mag 7 having their best day since their inception as a group. And one of the main ETFs tracking AI stocks also having its best day as well. A separate index tracking Chinese tech stocks, that rallied about 4.5%, and maybe that becomes a backdrop for when Asian markets open tomorrow. Let's bring Lei Qiu into this conversation right now over at AllianceBernstein, joining us here in Studio 2. And Lei, I am curious about this idea of sustainability of this rally. When we booked you, I had a whole nother set of questions, by the way, for you, so bear with me as I ad lib. But it gets to this idea of how much life you saw in that tech trade and whether what happened today maybe is additional fuel to that trade?
Well, I think to Jay's point earlier, there has been a lot of capital flow in the marketplace. And then, in my opinion, U.S. still have some of the most attractive technology stocks in the world. We have the tech dominance, and everything was on sale. So quality growth has been on sale, and that actually creates opportunities for long-term focused investors. Yeah. And also, in the midst of all this back and forth about tariff, the one thing that investors should bear in mind is, well, that really highlights the importance of selecting the right business model, which is great for active investors. Because at the end of the day, this highlights the question, who has pricing power? What is really defensive in this type of environment? So the companies that actually have differentiated IP, have spent and have invested and built a competitive moat that's hard to replicate, or have strategic assets, have strong balance sheet, those become the real defensive stocks in this market. And I think some of these most innovative companies are fit right into that category that have been really, the valuation have been pummeled.
So, I mean, some of the biggest holdings, at least in one of the main ETFs that you oversee, it's the NVIDIAs and Metas, I think Alibaba's in there and a few others. So we're talking about proven winners in terms of profitability, in terms of revenue, and obviously in terms of cash flow. Prior to today, did you have any concerns here about a potential slowdown in the growth of those names?
I think, when we look, what we're looking for long term is really for sustainable growth. So above market growth. And then if you look in terms of tech and innovation, that's become such an important part of all industries across all continents, frankly. So those companies, we believe, it's not just about growth, it's also about long-term margin, profit dollars. So it's not just revenue growth, but it's about profit pools. And we always thought the companies that should, even if they invest in the short term, that actually brings the long-term growth and long-term profit, and those are the ones that we like.
A lot of these companies that are included in your ETF has spent and invested a lot of money in building out their capabilities, especially when it comes to AI. Do they need to keep spending at that rate to continue to hold on to their advantage?
It's very hard to forecast, exactly how much they would spend, but we think that, in the long term, capital investments and spending R&D for growth companies generally actually pay off. But, it does mean that, as investors, we have to scrutinize and make sure that we agree with what they are doing. But overall, we think the capital intensity will likely remain high because from their standpoint, if you look at a business owner, some of the largest hyperscalers in the market, it's as much as about have a defensive mode, right? They have to protect their existing business, but it's also once in a lifetime opportunity to get into each other's backyard and to come up with new product to compete with each other. So it's as much as a defensive move as an offensive move. And that's why we think the capital intensity will likely remain high. Do we think the ebbs and flow from time to time? Sure. But overall, I think these are strategic investments and they will likely remain high.
They're strategic investments, but they're also an add-on to their main businesses. In the case of Meta, it relies on advertising when it comes down to it. And Dave Lee of Bloomberg Opinion was writing about how with the tariffs and with the uncertainty, that part of the business could get hit. And as a result, Meta has less money to plow back into spending on AI and building out that part of its business. Is that a risk for some of these biggest names that their core business will slow down?
There's always cyclical risk, right, in the economic slowdown. But great business models are the reason that we say we have to select the right business model, the one with the best gross margin profile, with the best cash flow profile. They will be able to withstand because when there's a slowdown, everybody sees the slowdown. And
so it's all relative.
Yeah, so it's all about relative.
All right, Lei, I really appreciate it. Always insightful. One of the best in the business. Lei Qiu, she's CIO for Thematic Innovation Equities over at AllianceBernstein. Join us here on a historic day in financial markets. The big question is it going to be a historic day for the economy? Let's bring in our next guest right now. Joining us right now around the desk is Olu Sonola. He's head of U.S. economic research over at Fitch. Olu, great to see you.
Thanks for having me.
I am curious here. Recession risk taken off the table based on what we learned today.
Yes.
That's your view?
I would say so. I think if the trade war is really all about China, that's a lot more manageable than a global trade war.
Well, that was the big concern heading into this trade war, whatever we want to call it, this idea that it was on a country-by-country basis rather than something being a little bit more holistic.
Yeah.
So how do you get 70-plus countries to line up and negotiate? We're still there, though, right? I mean, this is basically just a 90-day reprieve. They're still going to have to queue up, in theory.
Yes.
And at least for right now, two of the largest economies, China and the European Union as a whole, aren't in that queue, at least based on what we know.
Yes.
Are you ready to remodel your economic forecast now?
I think you don't have a choice. You have to, because China is about 15% of all imports. The EU is also about 15% of all imports. So you're talking 30% of the lot. The reality is, though, compared to what, 3 hours ago, we're in a much better place.
Yeah.
The concentration of the rate with China is a big one, right? We're talking 125%, right? So you're still looking at an effective rate that's in the 20s. You know, we were at 2.5%. This time.
You're talking about the overall effective tariff rate.
Yeah, exactly.
So if you just take that 125 that's just on China, that still puts us in the 20%
We're
range.
still at around 25%.
Wow.
Just on China alone, U.S. effective rate, the contribution of China alone is almost 18%.
Wow. But when we were up at
we were at 2.5%
coming into today, right?
Coming into today, we're about 25%. So the weight is still there. It's certainly a lot better.
Yeah.
But you know, we're not completely out of the woods.
Yeah.
If we zoom out a bit here, it's clear that we've averted a crisis for now. But what's the damage done from this past week?
It's hard to quantify. We will not know that for quite some time. Right. I think you cannot discount the damage from sentiment, the market swings, the damage. And when I say sentiments, I mean both on the consumer side and also the business side.
Yes.
I've been much more concerned about the business side because businesses can turn things off and off, turn things on and off very, very quickly, and they stop investing. And, you know, I looked at contractions, economic contractions going back a long time. And what you realize is the contribution to those contractions, it's mostly on the business side. About 80% of it, outside of COVID, has mostly been purely because businesses stopped spending and they stopped hiring and they started firing. So I'll be watching out for that. I'm hoping that, you know, we can have that full throated reversal whereby you're basically back to status quo where businesses can do business.
You know, one thing that strikes me is the damage to the U.S.'s reputation. The U.S. is trading more and more like an emerging market than a developed market. The price action shows big swings multiple times a day, several times a day in a row, and it's happening for days at a time. So you have this unpredictable policy that people now need to grapple with. And with Treasury yields spiking earlier in the day, there was a lot of talk that perhaps foreign buyers are backing out. They don't need to be in these so-called risk-free instruments when they look like there's a lot of risk attached to it.
Yes.
What is the damage done from that? I mean, does the U.S. still need to be a AAA country, or should it be something less than?
Actually, at Fitch, it's not a AAA country.
So to speak.
Yeah, right. Exactly. But I would say that when you think about the nature of the uncertainty, we've had pretty rough. We've had a very rough, I would actually certainly very, very rough couple of days, couple of weeks. If we settle where we are, yes, the total uncertainty is not completely out the door. If we settle where we are and we move on to other issues of the day, we move on to fiscal policy, we move on to things that will all basically be beneficial, right? Issues that will be ultimately likely be beneficial. Maybe we'll look at the rearview mirror and say, okay, that was a rough one, and maybe we're back on track. But I would clearly not throw out the window the fact that the last couple of weeks may have done some lasting damage.
Well, that's what I'm curious about, and maybe Scarlett didn't want to be as blunt about it, but the downgrade that we got on the U.S. wasn't because of what happened. It was because of this idea of chaos and disorder and uncertainty.
Yes.
Aren't we in a worse place when it comes to uncertainty today than where we were, back in 2011, 2012?
I think you can say we are, clearly, right? There is still a lot of dysfunction on the political side of things. It was one of the things that we cited.
Yeah.
We also cited the trajectory of debt. That has not improved. So compared to then and now, you clearly can say that we are in a worse place.
And the tax cuts won't change anything, the upcoming tax cuts that the Trump administration is so intent on passing.
I doubt that it will.
All right. Olu Sonola, head of U.S. economic research over at Fitch. Thank you so much for joining us.
Thank you for having me.
All right. We're going to continue this conversation now and bring in Nirupama Rao. She is assistant professor at the Ross School of Business at the University of Michigan. She's also a non-resident scholar at the Washington Center for Equitable Growth. And Nirupama, thank you so much for joining us. You have made the point that even if they rolled back the tariffs, which they apparently have done for everyone except for the countries that have retaliated, you can't roll back the incredible uncertainty this is all created. Talk about the damage that this disruption has done to the U.S. economy. We've seen firms like Goldman Sachs pull back their recession forecast. They no longer see a recession in the cards, but that doesn't mean that it's going to be a smooth ride from here.
I mean, let's first, before we even get to the uncertainty, let's talk about where the tariff rates seem to be. Right? We've had this 90-day pause, and I think the markets are very excited to hear about this. But at the same time, we're maintaining these tariffs with China. We're keeping across-the-board tariffs at 10%. So, this will probably average out to something in the realm of 12 to 14% tariffs across, on average. In 2024, the average U.S. tariff rate was 2.5%. So we're still seeing a quintupling of tariff rates. That's not going to be a non-event itself. Is it better than, a 34% or 46% rate on Vietnam? Sure, but it's not going to be easy. It's still, I think of it as the tariffs we're still imposing. It's like running a race with a parachute trailing behind you. As we see these retaliatory tariffs coming in, it's like we're now running into a headwind with that parachute. So that's the rates as they actually are, right? Now comes the uncertainty.
Sorry, please. I'm sorry. Let me just interrupt you there.
Sure.
It is because I know that the focus is on the actual tariff numbers themselves. And as you point out, and as Olu pointed out, we're still way elevated than what we were even just, 3 or 4 months ago.
Right.
But what's the perception right now? Is the United States open for business? And I don't mean just going to the White House and groveling for some sort of relief, but I mean, are foreign companies and nations going to be willing to invest in the United States given what's transpired over the last 11 or 12 weeks?
I mean, it's been an incredibly chaotic policy environment, right? We saw, Mexico is going to have a 25% tariff. No, never mind, we won't. Oh, no, it's back, but most goods will be exempted. China's going to have a 20% tariff. No, it'll be 54, then it'll be 104, now it's 125. We've seen so much policy change in such a brief amount of time. I think it's hard for any business leader to look at the U.S. economy and say, I know what this project, this factory, this investment, what it would cost me to build it, whether in the U.S. or abroad, and what demand would look like for my product. I think in this environment, it is very hard for businesses to make what we call irreversible investments.
A lot of countries now are looking for some sort of alternative to the U.S. And look, we are the largest economy, the most consequential economy for a wide variety of reasons. There is no replacement, at least on a one-to-one basis.
Right.
But that doesn't mean they can't sort of chip away around the edges. Claudia Sheinbaum, president of Mexico, had a meeting today with her counterpart in Brazil to strengthen ties there. And she said something I thought was interesting. She said Mexico, in good part, sustains the U.S. economy. I'm not so sure I believe that, but I do think there is a perception among Mexico, among China, and maybe to a smaller extent Europe, that actually feel that their contributions to the global economy, and more importantly to the U.S., are just as critical to our contributions, the U.S., to the rest of the world.
I mean, trade is about interdependence, right? I know economists like myself are often seen as the dismal science.
Yes.
There's a few places where we actually think that we can grow more, right? We can have more from what we actually have. In that, one of the ways is through innovation, right? When we create new products, we create new ways, we become more efficient. The other way is trade. Trade is a way to lean into each of our advantages to create more for everyone, right? And I think what Ms. Sheinbaum is saying and what other leaders are saying is they're pointing to this interdependence. And the truth is that, you can legislate, or not even legislate, you can dictate tariffs, but you can't dictate how markets respond to tariffs, right? We've seen that in our own stock markets, but we're going to see that playing out this time much like we did last time. What happened last time? We had tariffs on China. We saw trade moving to Vietnam, to Mexico. Factories were built. Markets will react.
What is the best way then to incentivize companies to move some of the high value manufacturing back to the United States? Because clearly adding tariffs onto imports was the way that the Trump administration has chosen to go, even as it fiddles with the actual amount and takes them off or puts them back on. The end goal here is still to bring jobs back or create high value jobs here.
I think you hit the nail on the head when you said high value jobs, right? Because we even see China trying to move away from low value manufacturing. So we want to be focusing on those high value industries. Across the board tariffs is going to make production in the US more expensive. So that's a difficult way to do it. I think a 10% tariff on Vietnam is unlikely to lead to shoes being made in the US as well. So we want to focus on high value added industries. We want to think about surgical tariffs potentially, but most importantly, investing here in the United States. Some of these industries need infrastructure that we can't currently provide. We need a workforce that's trained and ready for these jobs. I think, in truth, one of the most effective policies we could have pursued in this area was the CHIPS Act that we've actually seen the administration turn away from, right?
Yeah.
Is widespread industrial policy a good move for the United States? No. No. But if you're really interested in specific industries, bolstering them, it's encouraging investment.
Well, it'll be interesting to see whether they follow through on that. Scott Besson, of course, asked about that earlier today, and he did seem to suggest they are willing to go down that road. Nirupama Rao is assistant professor over at the Ross School of Business at the University of Michigan, as our coverage continues right here on Bloomberg.
All right, joining us now for more, just to recap the day and kind of get us set up for the following days, Julian Emanuel, Chief Equity and Quantitative Strategist over at Everscore ISI. Julian, a banner day here in the equity market and in the bond market with a big turnaround for both. A little bit less so for the bond market, but we still do have yields higher, at least at the short end of the curve. How sustainable is this recovery? How does this set us up for trading tomorrow and the following 89 days?
So this is the way we need to think about this, Scarlett. Coming into today, and if you think about it within the context of our putting out sort of bull cases, base cases, bear cases, we had 6,200 as our new bull case, 5,600 our base case, 4,500 our bear case, and 3,100 our super bear case. Recession, reasonably deep recession, multiple compression to around 15 times. What today has done is it's cut off the left tail outcome. Because what we learn is that in all likelihood, whether numerically this is the peak in trade uncertainty or it isn't, and obviously the math around what the effective tariff rate is still sort of a moving object, but investors perceive this to be the peak of trade uncertainty. And so in that respect, the only place to go in general is down in terms of that uncertainty. And then the other thing that we found out today is that, and we believe this all along, is that these actions really indicate that the Trump administration understands the precariousness of the situation and has no wish to precipitate a recession. So in that respect, as I say, you chop off the, really adverse outcomes and really balance the risks in the market. In our view, you're likely to have some backing and filling, but we think that looking further down, you're likely to move higher.
You're likely to move higher. And of course, it may take some time because we're still waiting for more details to emerge. How does this set us up for what Scott Bessent, the Treasury Secretary, said is his main priority now, which is getting those tax cuts done in the second half of the year? Is that something that investors should be looking ahead to now, given that we might be past peak tariff uncertainty?
Well, it's definitely focused. And I would suggest that, there are many reasons to think about the bond market volatility we've seen the last few days. Obviously, the narrative around the unattractiveness of U.S. assets relative to the rest of the world, the bond basis trade having difficulties, all of those have a degree of validity. But what also potentially has a degree of validity is this idea that you're going to need the Republicans to come together and vote on this big, beautiful bill, which includes debt debt ceiling relief and raising the debt ceiling, and you've got a swath of Republicans who've never voted to raise the debt ceiling. And in that respect, what you've done, and we've seen this in U.S. sovereign credit default swaps, is that they've ratcheted up in recent days. So part of this instability in the bond market could be forecasting that these negotiations will be difficult. And to us, that's part of the narrative of this is not sort of an off to the races situation. This is going to continue to be the type of 3 steps forward, 2 steps back bull market that we envisioned at the start of the year, only we had 4 steps back and maybe 1 step forward, but more balanced. But again, it really does taking off the potential for a deep recession because we know policy is going to react is a positive.
But there's still, I mean, we had a guest on earlier today, Julian, who kind of used the analogy, a crude analogy, but basically the idea is that we've gone from basically chopping off both of our arms to just one, at least economically speaking. I am curious about the rebound in markets, the sustained rebound in markets, because we're still 11% down from the all-time high on the S&P. What gets us there? Because it's got to be more than just passing a tax cut bill or a couple other favorable policies. There's got to be confidence put back into this market that those more pro-market, pro-business, pro-economic policies are going to stick, are going to be here to stay, and they're not going to be at risk of another snapback on tariff policy.
No, you're absolutely right about that. And in that respect, and look, we all know that confidence is very difficult to rebuild. And obviously, look, we've been saying this for several weeks, given the level of bearishness in the market in general, the third highest reading of bears only after the trough in 2009 and the trough of the Gulf War in 1990, both of which were generational buying opportunities. The degree of the rebound that we've seen on a reflex reaction is not surprising. But to your point, we are going to have to, rebuild this confidence. And it is not sort of a straight line. It is a process. And given the amount of policy that needs to be legislated and thinking about other things aside from tariffs, Russia and Ukraine, Iran, and so on and so forth, this is not going to be a, all back to normal. We are going to have an environment of heightened uncertainty and heightened volatility. Mm-hmm. But what we've done, again, is set the potential for a return to a more normalized environment. Yeah. And at this point, that's enough for
I'm just going to interrupt you for 1 second here, Julian, because on that point, some breaking news here for our viewers. This is on U.S. Steel. Those shares plunging about 13% in the after-hours trade. This as President Trump continues to make comments about his trade policy, now saying that he does not want U.S. Steel to go to Japan, of course, referring to that Nippon Steel deal that was on, was off, and maybe was back on again. In his words, he says, quote, "We love Japan, but U.S. Steel is a very special company, and he doesn't want it to go over there." You're seeing those shares oscillate. And Julian, I interrupted you on that point because I think it really sort of illustrates the idea that there is so much unresolved when it comes to White House trade policy. It's not just the overall reciprocal tariffs, but so many of these other moving parts. He was just talking about the TikTok sale a few minutes ago as well, saying that that's still on the table as a negotiating tool. So as a strategist, and as you've tried to sort of create some sort of reliable model, Julian, you have to do that, of course, against the backdrop of a president who is still driving the show, for better or for worse, and he's doing it in a way that probably is going to continue to be erratic.
Well, and look, to that point, again, as investors, we've all been frustrated, and the market has reflected that so much of the narrative around valuations and around the potential for earnings in the economy lies, in the heads and the opinions of one man at 1600 Pennsylvania Avenue. And to that point, that is a headwind for valuations going forward. But as I say, if there is a willingness to negotiate, which clearly there does seem to be, and a willingness to sort of, make sure that the growth trajectory of the economy is shaken but not stirred, as James Bond would have said, as we are, then, there is a path higher. But as you just pointed out, every headline is still going to be something that markets will react to.
Julian? Julian, great to have you. Julian Emanuel, Chief Equity and Quantitative Strategist over at Everscore ISI. You see that chart on the screen next to me, an 8% rally today, Scarlett, in the Dow Jones Industrial Average. And believe it or not, that was actually your laggard on the day.
I know. Pretty remarkable stuff. You look at the scorecard for how we ended the day. The S&P 500 staging its biggest advance since the global financial crisis, climbing 9.5%. The Nasdaq 100 surging 12%. This follows 4 days of painful, violent declines here in the major indexes. Nearly every stock in the major indexes gained. A mixed read in the bond market, and by recent standards, fairly muted moves, but that doesn't account for the big swings that we saw during trading.
It was wild, the Scarlett. I mean, you saw that huge jump that we saw earlier today, the huge reversal in yields on the long end of the curve I'm talking about. And then, of course, all of that activity shifted to the short end of the curve.
Yeah. Well, I mean, all it took was for President Trump to say he's putting a pause on the reciprocal tariffs, bringing everything down to 10%, except for those countries that have retaliated. There was a 10-year bond auction today that was received well. There's a 30-year bond auction tomorrow. Remember, in Asian trading, Romain, the 30-year reached 5%. It touched that level, came back down again. It is down right now by almost 4 basis points.
Absolutely here, and I'm actually really curious to see what happens when Asia wakes up and their markets actually have to take stock of what happened here in the U.S. That was a massive rally, and as Scarlett said, it was because of basically stripping away those reciprocal and retaliatory tariffs, those ones that had the potential to be 30, 40, 50, 60%. We're now at a baseline of 10%. But you know what he didn't do? He did not remove the tariffs on autos, steel, or aluminum. And I think our next guest might actually have something to say about that. Let's bring him into the conversation right now. Don Vultaggio is the the founder and chairman of Arizona Iced Tea. Don, great to have you here on the program. I am curious about how you've been navigating not so much just the increase in tariffs on things like metals and aluminum products, but more importantly, just kind of the day-to-day shifts in policy. How do you know what you're going to be paying tomorrow, if at all?
Don't. That's one of the problems, the uncertainty that exists right now. But we're navigating through it. We've been at it for 30 plus years. We've seen lots of ups and downs, and we'll see how it shakes out.
Is there a sense, I mean, as you sort of try to position your business for whatever times you're going through, you kind of have to look at it from two fronts. Obviously, your input costs, and you have to manage that. But at the same time, you also have to manage whatever consumer expectations are for demand and pricing. What does the balance look like right now, Don?
We're a brand that exists on the premise that you got to make it taste good and price it fair. And we've been doing that for a long time. So these bumps in the road, like aluminum and the Midwest premium that's associated with aluminum, is something we're dealing with. But the good news is people have to drink and they have to eat, and we're in a spot where most of the stuff we do in America is made here in America and comes from American sources. So we're not as exposed as some other companies who bring a big percentage of it from Asia or whatever. Of course, aluminum is one of the big factors. We use over 100 million pounds of aluminum annually, and we've been plagued with some of the fluctuations in the metal over the last couple of months. I mean, Midwest premium has jumped over more than double since the beginning of the year, and that's a factor that is something we question about what that's the legitimacy of that position that exists on the Midwest premium, because the Midwest premium was built on the premise of moving aluminum from the coast into the middle of the country. 20 years ago, that Midwest premium was 5 cents. Today, it's about, in the high 30s, low 40s. So you can see that a lot of the tariff implications have affected that Midwest premium, where LME is a traded metal.
Yeah.
And watch that.
So, Don, how are you managing that? How are you hedging against volatility in the price of that metal?
Right now, we're naked. We're just dealing with it. It's a month-to-month situation. Our aluminum is applied on a monthly basis to our can manufacturing, and we're absorbing it. Good news is we've gotten some decreases on things like freight and some oil and diesel and transportation. So, we got some positives, you got some negatives.
Okay.
So far, our decision is to hold pricing as we did during COVID. I made a decision that consumers in America don't need another guy raising price, not a guy like me. So, we're holding our steady, and we'll get through this, and we'll hopefully all this tariff stuff will ease itself out and aluminum will go back to what I'll call normal price. A good portion of our cans are made with recycled metal, which comes from, America, recycling that goes on in every state in the union. So a lot of this stuff is, I think, a manipulated, manufactured effect of tariff talks, and it affects the Midwest premium and sometimes unjust.
One thing that we can say for sure is that sentiment has been affected by the back and forth over the last week or so, and people are feeling a lot more concerned and worried about what's to come. How does that shape how you're thinking about launching new initiatives, new promotions, new products? Do you move forward with that regardless, or do you pull back a little bit given that people are sensitive in terms of pricing, in terms of how they want to spend?
Well, I told people we've got one of the largest marketing departments in the country because I'm 6'8", and I have not held back on any new initiatives. We're just introducing a vodka-based hard tea that just was produced last week. We've introduced a brand called Jumex Hard, which is nectars that we partnered up with a company in Mexico over, and then we have an Arizona Hard. So our initiatives are the same. We haven't pulled back any of that stuff. And again, those things that consumers expect from a company like us, they're, half of America, I think, is not invested in the stock market. They're invested when they go shopping and see a price that they like, they buy. And that's what we're about. We offer great value, great taste. And the things that are out of our control, we deal with. The things within our control, we're focused on transporting stuff. We've moved a lot towards rail and intermodal trucks, which are a way to move product around at a lesser cost. We have a new facility, which is where I'm sitting today, over in New Jersey, that has rail spurs, and we've taken thousands of trucks off the road by having the ability to have rail. So those are the things that we do some cost savings, and then when aluminum comes around and other things, we deal with it.
All right.
We have no other choice, right?
Don, thank you for sharing what you're doing and being so candid. Don Vultaggio is Arizona Beverages founder and chairman. As he mentioned, they're naked when it comes to the exposure to aluminum prices, but they are able to make some changes around the edges and keep their costs, in the end, neutral.
And he mentioned, of course, the new Arizona hard tea. Speaking of which, Constellation Brands, of course, the maker of Modelo Beer, Corona, and several other alcoholic drinks, out with their earnings here. As expected, they weren't necessarily good. Comp sales in the most recent quarter did come in above estimates, but on a category basis, you did see some significant weaknesses. Beer shipment volume was down about 2%. Beer depletion volume down about 1%. Wine and spirits shipment volume coming in up 3.5%. That was better than expected, though the company did provide a full year forecast for its fiscal 2026 year, and all of those estimates were well below what the street was looking for. The company sees comp EPS at $12.60 to $12.90 a share. The street was looking for $14.09. The company also saying that it sees wines and spirits net sales change down in a range of -17% to -20%, and beer sales will be flat to up 3%. We are continuing our focus here on the big rebound on the back, of course, that reprieve that President Trump offered on those tariffs, a 90-day reprieve. And it's raising a lot of questions about why so many of these tariff decisions are being made unilaterally out of the White House. Congress has finally woken up. Senator Chuck Grassley and 6 other Republicans have introduced a measure that would require Congress to review and approve most tariffs within 60 days. Now, Trump has already heard about this bill and has threatened to veto it if it passes. Patricia Lopez of Bloomberg Opinion wrote about it earlier today, saying that congressional Republicans and Democrats should actually join forces on this, reclaim their power, restore checks and balances. Patricia Lopez joins us right now. And Patricia, I'm not sure there are any checks and balances left in this government. So give me some hope here. When I see a Republican, a prominent Republican like Grassley, signing his name to something, pairing up with people, a prominent Democrat like Maria Cantwell, am I to believe that there is maybe some potential here for Congress to actually do its job?
There is a chance. It's going to be hard because he's not going to give up that kind of power easily. It's been held for a long time. Democratic presidents, Republican presidents have had this power, but they've used it so sparingly. That's the real distinction here. President Trump it got this new toy, and he has just gone crazy with it. And you've seen the reaction. And I think it takes a lot for somebody like a president of the Senate, Chuck Grassley from Iowa. He's been a Trump guy. He has been supportive of tariffs, in limited measure. But I think this just went too wild for him, and he has said that they gave too much authority away. And then you've got Don Bacon in the House from Nebraska, another red state. And they've got a good cause to join with Democrats on this, because there are a number of Democrats that are quite supportive of tariffs, especially in blue manufacturing states.
Right.
And we've seen that, we've seen that already.
And we've seen that in states where the district could easily tip into the red as well. But we know that House Speaker Mike Johnson said he wouldn't bring any bill like this to the floor for a vote. So it feels like it's DOA, but does this at least sow the seeds for the beginning of some bipartisan policymaking?
I think it does. I was a little surprised to see how many Republicans joined Grassley on this bill and how quickly. First it was 4, then all of a sudden it was a half dozen. Bacon's got, probably almost a dozen that are equally interested. And that is signaling something to the leaders. So nothing is ever dead in Congress until it adjourns. I've learned that over many years as a legislative reporter. Things can come back from the dead quite easily. I think there's kind of a 90-day shot clock going on here that started with the president's 90-day pause. And that gives them a little time to regroup, to plot some strategy, maybe make some coalitions. I think it'll be important for Democrats not to demonize Republicans too much, give them some space to try to join them. And I think it's very possible. And it's a necessary correction. We've seen that no individual should have this level of power to affect the global economy.
Thank you. Patricia Lopez of Bloomberg Opinion. Appreciate it. All right, we have a headline here from President Trump saying he cannot imagine further increasing China tariffs. Remember, he did raise the duties on China to 125%, even as he announced a 90-day pause on other tariffs on other countries that did not retaliate. Gina Martin-Adams, Chief Equity Strategist with Bloomberg Intelligence, joins us now. How does this shape up? How does this set us up for tomorrow's trading? Does China fall or rise, and does that kind of set the tone for what happens in U.S. markets?
Sure. Put me right on the spot there, Scarlett. To predict the markets in the most volatile period we've had since October of 2008. I think that generally there's a bit of relief that's going to pass over global stocks as a result of the fact that things are not as bad as most investors had feared coming into today. We saw that with the U.S. trade. We'll likely see that throughout the rest of the world. In terms of China, it's very difficult to say because China's been the one economy that has pushed back hardest against Trump's tariffs. We're already starting to see lots of economic slowdown as a result of a manifestation of these tariffs. So, it remains to be seen how China reacts. The Chinese equity market, very interestingly, though, was one of the worst behaving equity markets already. So the China equity market does appear to have priced in a tremendous amount of weakness as it is, and is not as levered to the economy, I think, as is commonly believed. The equity market is more tech stocks. It's not necessarily completely levered to what's happening in underlying economic conditions. So you could very easily see a recovery in China tech specifically lead the Chinese equity market, just like our tech led here.
Let's just circle back quick, 30 seconds, to the U.S. markets. Did anything change in your fundamental view over the last few hours, given that the worst case scenario, at least with tariffs, are removed, or at least removed for 90 days?
Yeah, so the wonderful thing about our process is we don't have a view. We don't have an opinion. We really just follow the data as it's moving. And the data pre-tariff implementation, pre-tariff announcement was already starting to deteriorate because there's so much uncertainty as to what's happening in the economic climate. So nothing changes in our process as a result of this. You do have the re-rating, maybe some improvement in technicals.
All right, Gina Martin-Adams, our Chief Equity Strategist over at Bloomberg Intelligence. Definitely a team you want to keep an eye on over the next few days as we try to sort through all of the market chaos. As far as the Washington chaos, Kaylee and Joe are up next at the top of the hour with Balance of Power, right here on Bloomberg.